In a notable shift within the cryptocurrency landscape, Janover, a software company that has recently pivoted towards accumulating digital assets, saw its shares soar after announcing its first significant purchase of Solana's SOL token. On April 10, 2025, the firm revealed that it had acquired $4.6 million worth of SOL, a move that sent its stock price surging by over 60% at one point, reflecting the growing investor interest in crypto-related ventures. Janover's recent activities come on the heels of a $42 million capital raise through a private offering of convertible notes and warrants, which the company earmarked for its acquisition strategy focused on Solana. CEO Joseph Onorati emphasized the company's commitment to becoming a transparent and efficient player in the public markets for crypto accumulation. Executing our first SOL purchase within days of completing our restructuring reflects that commitment, he stated, highlighting the strategic alignment of their operations with current market trends. Founded in 2018, Janover recently underwent a significant transformation when a group of former executives from the popular cryptocurrency exchange Kraken took majority ownership. This leadership change prompted a rebranding initiative, with Janover set to adopt the name DeFi Development Corporation and revise its ticker symbol accordingly. This strategic overhaul is reminiscent of the approach taken by Strategy, formerly known as MicroStrategy, which has famously accumulated substantial Bitcoin holdings. As part of its long-term strategy, Janover plans not only to continue acquiring SOL tokens but also to invest in validators, the computing entities that facilitate the verification of transactions on the Solana network. By acquiring these validators, Janover aims to enhance its operational capabilities within the Solana ecosystem, allowing it to stake its SOL tokens and earn rewards in the process. However, the broader market conditions present a mixed picture. Despite Janover's gains, the SOL token itself experienced a more than 8% decline on the same day, reflecting the volatility that has characterized the cryptocurrency market in recent months. Notably, SOL has seen a 43% decrease this year, despite having outperformed many of its peers during a brief rally in late January. This recent activity by Janover and the volatility of the Solana token highlight the dynamic nature of the cryptocurrency space, where strategic acquisitions and market sentiment can drastically affect valuations. As Janover continues its journey into the crypto realm, the company's ability to navigate these challenges will be crucial. Looking ahead, Janover's ambitious plans could position it favorably in an increasingly competitive market. With the backing of experienced leadership and a clear strategy for building a robust crypto treasury, the company may well become a significant player as digital assets continue to gain traction in the financial ecosystem. As the regulatory landscape evolves and new technologies emerge, the implications of Janover's strategy and the overall developments in the cryptocurrency market will be closely watched by investors and analysts alike. In a striking forecast for the cryptocurrency market, Charles Hoskinson, the founder of the Cardano blockchain, has predicted that Bitcoin could surge to an astonishing $250,000 by the end of this year. Hoskinson shared his insights during a recent appearance on CNBC's Beyond the Valley podcast, attributing this potential rise to several converging factors, including increased adoption of cryptocurrencies and prospective legislative changes. Despite Bitcoin's recent struggles trading below $77,000 just a week ago, the market saw a brief resurgence, climbing above $82,000 as President Donald Trump announced a temporary reduction in tariffs, potentially signaling a stabilization in global trade. Nevertheless, this price remains significantly lower than the record high of over $100,000 reached in January. Hoskinson remains optimistic, suggesting that the current market volatility will eventually give way to renewed investor confidence. What will happen is that the tariff stuff will be a dud and that people will realize that the world is willing to negotiate, he stated. This sentiment reflects his belief that a return to a more stable economic environment, coupled with favorable monetary policy from the Federal Reserve, will drive substantial investments into cryptocurrencies. Hoskinson pointed out that the number of cryptocurrency users has surged, with a 13% year-on-year increase reported by Crypto.com, bringing the total to approximately 659 million. He emphasized the geopolitical shifts complicating global trade, suggesting that as traditional systems falter, cryptocurrencies may emerge as a viable alternative. Your only option for globalization is crypto, he remarked, highlighting the growing need for decentralized financial systems amid increasing tensions between major world powers. Another significant factor in Hoskinson's bullish outlook is the anticipated passage of new legislation related to stablecoins. He noted that the Magnificent Seven, a term used to describe major tech firms including Apple and Amazon, may soon adopt stablecoins for various transactions. This would not only streamline international payments for these companies but also potentially enhance user engagement within their platforms. Stablecoins can be sent quickly from one wallet to another across the world, he explained, positioning them as a practical solution for global commerce. Looking ahead, Hoskinson predicts a period of stagnation in the crypto markets over the next few months, followed by a resurgence in speculative interest around August or September. He anticipates that the combined effects of regulatory clarity and increased corporate adoption of stablecoins will reignite enthusiasm in the crypto space, thus potentially leading to a new market rally that could last for the following 6 to 12 months. As the landscape continues to evolve, Hoskinson's insights underscore a pivotal moment for cryptocurrencies. With regulatory frameworks being established and major corporations beginning to engage with digital assets, the stage is set for a transformative year ahead in the world of cryptocurrency. The developments in legislation and corporate adoption could very well determine the trajectory of Bitcoin and the broader digital asset market. As the year progresses, all eyes will be on these unfolding trends, which may reshape the future of finance as we know it. In a rapidly evolving landscape of cryptocurrency and economic policy, recent developments have sent ripples through both markets and legislative chambers. A notable shift occurred when President Donald Trump announced a 90-day pause on most tariffs, a decision that has significantly impacted the cryptocurrency sector. This announcement has not only helped to stabilize crypto prices, which had been in a steady decline, but it has also reignited discussions around regulatory clarity in the U.S. as lawmakers grapple with the complexities of digital assets. Following Trump's announcement, cryptocurrencies experienced a resurgence. Bitcoin, which had plummeted to around $74,500, surged to approximately $83,000 shortly after the president's post on Truth Social, which included a reduction of tariffs to a base rate of 10% for most countries. This sudden bullish trend extended to related stocks. Shares of crypto-focused companies like Bitcoin buyer strategy and trading platform Robinhood Markets jumped 24% and 22% respectively. This market enthusiasm reflects a broader sentiment where risk assets, including equities and cryptocurrencies, are reacting sharply to changes in fiscal policy. Analysts suggest that the crypto market, previously caught in a downward spiral due to fears surrounding the tariffs, is now rebounding as investors regain confidence. John Todaro, an analyst at Needham & Company, noted this environment is very much macro-driven, indicating that the fluctuations in the crypto market are closely tied to economic uncertainties and policy changes. The pause on tariffs alleviates some of the risk-off sentiment that had dominated investor behavior in recent weeks. However, the tariff situation remains complex, particularly concerning China, which has seen its tariffs increase to as high as 125%. While this has created volatility, it underscores the nuanced relationship between international trade policy and cryptocurrency markets. As the global financial landscape continues to navigate these challenges, the repercussions of Trump's decisions will likely resonate throughout various sectors. Amidst this backdrop, U.S. lawmakers are calling for greater clarity in cryptocurrency regulation. During a recent House Financial Services Committee meeting, bipartisan representatives expressed a unified demand for updated frameworks surrounding digital assets. Concerns were raised about how Trump's involvement in cryptocurrency, particularly through initiatives like meme coins, could complicate legislative efforts. Reports suggest that the Trump family has generated significant revenue through these ventures, estimated at over $800 million, leading to heightened scrutiny. The discussions among lawmakers also highlighted the need to define digital assets more clearly, particularly in distinguishing between commodities and securities. Witnesses from the crypto community pointed out that current regulatory frameworks, notably the SEC's application of the Howey test, are inadequate for addressing the complexities of digital asset transactions. With Paul Atkins recently confirmed as the new SEC chair, there are hopes that his leadership could pave the way for more proactive and constructive regulatory measures. As the cryptocurrency market continues to stabilize and lawmakers work toward establishing a clearer regulatory landscape, the future remains uncertain yet promising. The interplay between economic policy and digital assets will undoubtedly shape the trajectory of both markets and regulations. As this situation develops, stakeholders in the cryptocurrency realm will be watching closely to see how these initiatives will unfold and what they may mean for the long-term viability of digital assets in the American economy. In a dramatic turn of events, Ethereum ETH has recently plunged to levels reminiscent of early 2020, a time marked by unprecedented volatility in the cryptocurrency market. Currently trading around $1,380. Ethereum's price has crossed a critical psychological threshold that many investors have not encountered since the early days of the COVID-19 pandemic. This significant decline has reignited fears within the crypto community, raising questions about the asset's resilience in the face of macroeconomic pressures. The backdrop to this turmoil includes a constellation of factors: rising geopolitical tensions, persistent inflation, and the specter of a global recession have combined to create a climate of uncertainty for investors. Unlike the health-related fears of 2020, the current climate is defined by economic anxieties that have left many crypto assets, including Ethereum, in a state of paralysis. However, a rare on-chain indicator has emerged suggesting a potential for recovery. The realized price of Ethereum, which represents the average price at which all ETH tokens in circulation were last moved, now sits at approximately $2,000, significantly above its current market value. Historical trends indicate that when the realized price exceeds the market price, it often signifies an accumulation phase preceding potential rebounds. Analyst Carl Runfeld pointed out that a similar scenario unfolded in March 2020 when Ethereum experienced a drastic drop from $283 to $109, only to multiply its value by 15 in the subsequent year. Yet the current landscape for Ethereum is markedly different. The ecosystem has matured with advancements in smart contracts, decentralized finance, DeFi, and non-fungible tokens (NFTs) giving rise to new use cases. The ongoing decline in Ethereum's price raises pressing questions about the durability of these innovations in the face of economic headwinds. Institutional investors who once viewed Ethereum and its applications favorably are increasingly gravitating towards safer assets, undermining the long-term bullish narrative that many had anticipated. The breach of the $1,500 support level has acted as a tipping point for Ethereum, triggering a cascade of sell-offs among investors. As the price struggled to stabilize, Bitcoin unexpectedly surged following an announcement from former President Donald Trump, who suspended tariffs for 90 days, with several countries temporarily buoying the market. Bitcoin spiked to over $82,000 and briefly lifted Ethereum to $1,689 before settling back around $1,592. However, the subsequent attempts at recovery have been met with resistance, as each upward movement has become an opportunity for sellers to exit positions, perpetuating a downward spiral. Market psychology plays a crucial role in this dynamic. An old market adage aptly captures the sentiment: prices go up by the stairs and down by the elevator. For Ethereum to regain a foothold, it must reclaim the $1,850 mark, a significant resistance level. However, with a relative strength index RSI indicating chronic oversold conditions and trading volumes dwindling, the prospect for a sustainable rebound appears dim. Moreover, a further decline below the $1,380 mark could propel Ethereum towards a perilous zone around $1,000.
Compounding these issues are weak inflows into Ethereum's spot exchange-traded funds ETFs, reflecting a broader lack of investor interest.
Recent data indicates that Ethereum ETFs have experienced over $94 million in outflows in the past 2 weeks, with a mere $13 million in inflows. This trend raises concerns, especially given that institutional demand has been a critical driver of Ethereum's value in the past. As Ethereum faces mounting challenges, some investors are seeking refuge in alternative projects. Notably, Mutuum Finance, a DeFi project currently in its pre-sale phase, is gaining traction despite Ethereum's downturn. With over $6.5 million raised and more than 8,100 investors participating, Mutuum Finance is positioning itself as a beacon of opportunity amid the chaos. The project's innovative lending solutions and focus on user empowerment could attract those disillusioned by Ethereum's recent performance. In conclusion, while Ethereum's current price drop evokes memories of past market cycles, the unique circumstances surrounding its decline suggest that the road to recovery will be fraught with challenges. As the market grapples with economic uncertainties, the focus will shift to how Ethereum adapts to the evolving landscape of digital finance and whether it can reclaim investor confidence. The coming months will be crucial in determining whether Ethereum can leverage its mature ecosystem to navigate these turbulent waters, or if it will be relegated to the sidelines as new contenders emerge. In a significant development for the cryptocurrency market, Janover, a relatively small software company, has experienced a remarkable surge in its stock price following its first acquisition of the Solana token. The company purchased $4.6 million worth of Solana's SOL tokens on April 10, 2025, a move that has sparked considerable interest from investors and analysts alike. This acquisition comes on the heels of Janover's recent capital raise, where it secured $42 million through a private offering of convertible notes and warrants aimed specifically at accumulating crypto assets. Janover's stock price soared by more than 60% shortly after the announcement, reflecting a noteworthy market reaction that initially drove the shares up more than 100% earlier in the trading day. This dramatic rise underscores the growing enthusiasm surrounding cryptocurrencies and the potential for companies to leverage digital assets as a strategic component of their financial portfolios. Our aim is to be the most efficient and transparent vehicle for crypto accumulation in the public markets, stated Janover CEO Joseph Onorati, emphasizing the company's commitment to transparency and efficiency in its operations. Founded in 2018, Janover has recently undergone a restructuring led by a team of former executives from the Kraken cryptocurrency exchange who now hold majority ownership of the firm. This leadership shift has paved the way for a new crypto-focused treasury management strategy, which includes plans to change the company's name to DeFi Development Corporation along with a revision of its ticker symbol. The firm is not only poised to acquire SOL tokens regularly but also intends to invest in validators, computers that support the Solana network, by verifying transactions. This dual approach allows Janover to accumulate SOL tokens while also earning staking rewards through these validators. Despite Janover's bullish outlook, the broader market for the SOL token has been volatile. On the same day as Janover's announcement, SOL experienced a decline of over 8%, reflecting a broader trend where risk assets began to retract from a recent rally. In fact, SOL has faced a challenging year, down approximately 43% in 2025 after peaking in late January when it outperformed many other cryptocurrencies. The cryptocurrency landscape is continuously evolving, and investors are keenly observing how companies like Janover adapt to and capitalize on these changes. With its ambitious plans for regular SOL acquisitions and validator investments, Janover positions itself as a potentially significant player in the cryptocurrency market, drawing parallels to strategies previously employed by companies like MicroStrategy, which famously adopted a Bitcoin accumulation strategy. As the crypto market matures, the implications of Janover's strategy may resonate beyond its own stock performance. The company's approach reflects a growing trend among firms to embrace digital assets as part of their treasury management, potentially setting a precedent for other public companies to follow.
Looking ahead, the developments surrounding Janover and its acquisition of Solana tokens will likely be a focal point for investors and analysts seeking insight into the future of cryptocurrency treasury strategies.
The success or challenges faced by Janover could influence how other companies approach their own cryptocurrency investments, especially as the market continues to fluctuate and evolve.